Well, we have roughly 1.5 hours for these two sessions, and we will not take a break in between, so hopefully we'll be able to complete a very short introduction to Takaful and Re-Takaful for everybody. Just to start with, anybody here who has done any Takaful or insurance work?
Keep this in case you want to sit.
Shukriya. So that's good to know. So we can start from scratch and take you through the loops. Yeah. I myself had not done any insurance work until 10 years ago. I did investments for an insurance company, but that's not insurance, as you will very quickly realize. So what I'm trying to tell you that it is possible to come up to speed in insurance and Takaful quite quickly. And a lot of the conceptual issues which you find in other aspects of Islamic finance can be addressed through Takaful modalities much more neatly and in a much more satisfying manner. So I think it is worthwhile for Islamic finance professionals to have just a window into what Takaful is and how it is operated. So what we want to do today is essentially to give you a very quick overview of what insurance is about, and then take you into what are the distinguishing features of Takaful as opposed to insurance, take you to the development of operating models of Takaful quickly, asset management, because as you will quickly learn that in large parts of the insurance industry, the key is asset management, it's not insurance. And you will see why that is so. And that is where it will feed into your work on into sukuks and project management, project finance, and so on, why this becomes important for the Takaful industry. Then there are marketing and distribution challenges in Takaful, which we will look at in some detail. And we will move on to looking at Re-Takaful and risk management. This is a much more technical and complicated issue, so we will just guide you into it and not text you much. And finally, look at some emerging issues. So I hope to complete this overview in about 1.5 hours, inshallah, if you bear with me. A very quick slide on the global dimensions of the Takaful and Re-Takaful industry at present. We have roughly 143 providers, Takaful and Re-Takaful providers, and 179 if you include some of the windows. So there's roughly 36 windows there, making 179. The total contribution pool, that is the receipts of Takaful premiums or contributions, at the end of this year is forecast to be about $12 billion US, which is not very big compared to insurance premiums globally, but it's not small anymore. 12 billion is not a small number. Also, in Takaful and insurance generally, you will see there is always a split between what we call general insurance and what we call life or family insurance. And that split is also beginning to change more towards life and family. Despite significant problems, there are also significant growth areas and avenues for Takaful. Simply because, as we will see, overall insurance penetration rates in most of the Muslim countries are quite small. And if they come up to levels which should be in keeping with their GDP levels of increase, then nobody else will do anything other than Takaful. But you know, these are consultancy projects and projections. They come to reality, then you have Professor Ashraf becoming the head of a big empire. But there is potential there. But there are, of course, obstacles to achieving that potential. When I say there is a potential for insurance, it doesn't mean there will be potential for Takaful. So even in a jurisdiction like Malaysia, where perhaps we would see or we would judge that to be a most user-friendly and enabling jurisdiction for Takaful, the amount of the insurance industry taken by Takaful is about 10 to 12%, if I'm not mistaken. 30 years of Takaful, the central bank bending over backwards to help you, and everything else. Still, we are taking 10% of the insurance industry. So if insurance is growing, it doesn't mean Takaful is growing as well at the same rate. There are challenges there which need to be looked at. 10, 15 years ago, there was a big challenge that there was no Re-Takaful provision. Re-Takaful is equivalent to reinsurance, and maybe we'll see insurance and see what is the need for reinsurance. Today, I think the challenge is much less. Probably 60% of all Takaful can be actually made available to existing Re-Takaful companies. So that's a little bit less of a challenge. And then we have this huge group of insurance which we call retro. Retro insurance or retro Takaful. These are for huge risks. So typically if you have risks for, say, aviation accidents, earthquakes, tsunamis, hurricanes and so on, can you insure them? And if you can you do it through Takaful companies? So we look at some of the big issues there in terms of capital requirements, in terms of spread and so on. But we need to understand insurance to be able to understand what can be done here and what cannot be done. Just one word of caution before we move on to substantive issues is that insurance relies in principle on sharing of risk. Now, as you know that many risks do not reside in neat pockets or exclusive to Muslim countries. So for example, if you look at aviation risk, an aircraft disaster can happen anywhere in the world. In order to ensure that, you need to pool those risks. So we have here a question of pooling risks from jurisdictions, peoples, places, which have no concern with Takaful. And so how do we make a program which is acceptable to both sides? So here there are boundaries to how much Sharia compliance we can have in the insurance contract there. And that is specifically quite a big challenge in retro, because retro risks are global and so on. But this is the last point we will see. Just I'm giving you this word of caution to start with. Don't think that you can solve every problem in 1.5 hour session, okay? Now, this is just a quick overview of the growth of the Takaful premiums, right? Globally. This is taken from the Ernst & Young 2012 World Takaful report. At the end of the slides, I have put the URL for this particular set of reports in the Ernst & Young library, 2009, 10, 11, and 12. So quite useful if you want to explore the industry further. And you will see that a big component of that, of the 12 billion, 5.5, that's the yellow section there, is the Saudi cooperative, which in many people's views now is not strictly Takaful. And we will see why yes or no towards the end of this session. So the industry is about half and half. And in the other half, there are still things which may present challenges to classify them as Takaful. So this is as much a glorified view as you can. The only proper Takaful probably is about a quarter, which you can put your hand on your heart and say, yes, this is Takaful. The others are getting. And this shows you the lines of business. The yellow bars represent what we call family and medical Takaful. And you will see that they vary from jurisdiction to jurisdiction. In total, on the right side, about half the whole business is family. But in places like Southeast Asia, India, Indian subcontinent, and so on, up to 2/3 can be life. Whereas in places like Iran, only about 1/3 is life. So there is a difference in composition, and as you understand insurance better, you will see why this should be so, and why this also presents challenges and opportunities of different kinds in the market. Okay, so insurance. So why would you take insurance? Anybody?
Prevent the loss.
Of what?
Something you do not anticipate.
But does it have to be big enough?
Depends on the individual. Risk averseness.
Would you take insurance for your laptop?
I don't. I don't have that.
Why not?
For now, it's a commodity. Can be replaced.
Exactly. You can afford to replace it reasonably easily. You don't like it to be stolen or broken, but it's not a life changer, right?
It's legally, you don't have to take insurance for a laptop.
No, legal is one thing.
Yeah.
Don't worry about legal. I'm simply a mindset. Why do you want insurance makes sense to you in some things, right?
It's to prevent, I think, major setbacks.
Okay. So would you take an insurance on your home?
Yes.
Because it's a lifetime investment, right? If your home is, say, burnt down, God forbid, that's a life's earnings gone. Yes?
Yeah, to reduce risk and to be, I forgot the second one.
Okay, that's fine. I think you understand it now that for insurance, for things which you can own or you can feel, has to be sufficiently large to create a problem for you, right? So you say it's worth paying something to get peace of mind that if something happens, I can be compensated for that.
Yeah, compensation.
Yes?
Reduce risk
Okay.
and compensate.
Well, there's maintenance as well, ongoing household goods, where you
No, those
insurance.
contents you might not take.
No, insurance on maintenance of
Yeah,
various
you might not take, you see, but the whole building you're more likely to take,
Yeah.
right? Now, the question comes, and these kind of things which you can feel, which you own, they are called in insurance language general lines. General. Okay? So if you look at insurance law, you will see general business or general lines, or things like that, right? For these, how would I go pricing any protection? Say for home, buildings, the whole building, how do I price it? No, market value is there. Okay, I will replace you by, but how do I say your premium is 200, 300, 400?
Percentage, your record,
Record of what?
your risks, what do you do for living, the area, the environment, close to a river.
actualization of many of the claims.
The ability of the premium to replace the property itself.
Yes, but that is dependent on what? How many will be destroyed? Yeah? Say if you have 20 people here, right? And we say that probably, according to records and looking at everything else, maybe every 5 years, one house will be burnt down, okay?
Yeah, statistics.
Maybe. That's what's happened in the past. And so we can begin to price it. Say if everybody pays X amount per year, in 5 years or every 5 years we will have that kind of pot to compensate anyone who is unfortunate to lose their house. Yes? So it depends on a lot of statistical work to determine the risk elements. Yes?
And doesn't it also depend on how many people are in the pool?
Yeah. So how many people is a different part of probability. and it is this. If I tell you that I'm going to toss a coin, you know that the probability of heads or tails is 50-50, right? Yes?
Yeah.
If I toss a coin 10 times, what will I get?
Unknown.
Eh?
We don't know.
It could be 10 heads, yes? What happens if I toss it 5,000 times? Not quite.
Not getting that. Quite.
What if I toss it 5 million times?
Probability will increase.
I will get closer to 50-50, to the theoretical probability, right? That's your answer. The larger the pool, you will get nearer to the theoretical probability.
Right.
And so the pricing will be that much more easier for you to do, right? If you have a very small pool, you are taking a higher risk because your chances of getting near the theoretical probability is small, and so your pricing is also, and therefore you need a very specialist agency to price that risk. And also the pricing may not be keen. It is not now a product which everybody can delve in. So you see, now one of the principles of insurance generally is large enough pool and a defined insured interest risk. That makes it easy. Now that is to do with general insurance items, which depend on the incidence of loss of those items. As long as you can document them, you can price them. There is another category of risk which depends on life. So essentially with ill health or death, whether you call it life insurance or family takaful or so on, the crystallizing event is either death or illness, right? How do you price life contracts? How do you price them?
Well, how do you price as far as
Get the record.
Of what?
The person or the age
Depend on
or
age.
the life expectancy. The condition.
The main factor is life expectancy, right? And you will see that life expectancy, again, it depends on large numbers, because at a large enough pool, on average, somebody will die at the expected life expectancy, right? Not everybody, but on average.
As the lesion is.
Exactly. So what is the life expectancy here, for example? In the UK? 70.
90?
80 and 84. 84 men, 84 for women. Women are on average living 4 years more in every place. Okay? They're lucky but costly if you do a pension contract. Yes? Because you have to pay 4 years more. So if you are pricing something here, you are looking at an average lifespan of 80. You're coming from Indonesia? Philippines. What is your life expectancy there, average? I think it's 58, 62. All right? So it's quite different from here.
UAE hundreds.
Huh?
UAE hundreds.
No, UAE also is very short actually. It's about 52, 56 because of several factors which we haven't got time to go into. But one of them is large number of accidents, road accidents and so on in young people. Yours is primary disease and so on in Philippines and so on. But that's fine. But you see, so the pricing of life contracts will change from Philippines to UAE to UK because life expectancy is different. But the key building block of the life or family contracts is life expectancy, and then everything else you build around it. Okay? So you have two categories of insurance contracts here. One is general, which are things you own, and one is based on life. And then you have derivatives of life. Because really life or family, you are using it mostly as an investment vehicle. So a typical life contract will say, for example, okay, I'm saving this for, say, to educate my son. And at the age of when he is 20, whatever is accumulated, I will give it to him, right? So the company will take my premium or contribution, keep a little bit for covering the risk, which I will explain you what is the risk, and the bulk of it they will invest into an asset fund to grow to that level. The only question now left for me is that what happens if I die before the 20 years is up? Now I cannot pay the premium anymore, right? So the risk covers that eventuality. Although I am still young, I'm not 80, and I'm not expected to die at 80, but these things will happen and can happen. So that's what the life cover is about, right? To supplement that possibility. It's not doing anything else. That's why it can, in Malaysia and other places, it's called family takaful, because it's really protecting the family against unforeseen events like that, right? Now, what will increase the amount of insurance you need?
The number of beneficiaries.
No, that's fine, but what else?
Lifestyle,
And lifestyle depends on what?
smoking habits,
The income.
Okay, that's life side. What about general?
Fine.
the place you where you reside.
The amount of money you have.
Yeah.
Because the more money you have, the more assets you have. The more assets you have, the more protection you need for them, right?
It's not only that.
What else?
You can find some people who don't even have enough to eat, but they have more children, 8, 9, 10.
No, that's fine. Children is not a problem. The problem is that the amount of cover you need, right? If you have one house, or a bigger house, or even a bigger house, or just a hut, your insurance requirement is different, right? It's changing. And then you have 3 cars, and then you have X, Y, Z. So it is dependent on your wealth overall. And that's what we call the GDP level, yeah? Gross domestic product per person, per capita, or whatever. As that changes, the amount of insurance you need changes. As a general rule of thumb, it doesn't always hold, which we will see, but just to give you an idea where the growth in insurance comes from. And then you will see that some countries are obsessed about insurance. So for example, the UK is the most highly insured country in the world. Because first of all, we start with what we call national insurance. What is national insurance, Noor? Huh?
That why NI number you mean?
Yeah, NI.
Yeah.
So when you start working, are you working?
Yeah.
Yeah. How much of your salary is taken off at source?
No, actually, I'm not working here. I used to have
So-
NI number.
So you see,
Anymore.
you don't know. If you get a salary here, Shafiq, how much your salary goes?
30%.
It's big, yeah? You think my salary should be 3,000 a month gross. And when you see it's only 1,000 at the bottom, you say, where is this 2,000 gone? Tax, NI, all these bits and pieces, yeah? It's 12.5% on the person who is working and 12.5% from the employer. Now, that is a national insurance scheme. What does it cover?
Health, education, and some public sector things,
Unemployment.
unemployment benefits. And things like that.
So it is an insurance scheme, right? It covers all these things. Huh? The whole of the social. And then on top you will have other insurance for your own self, for your car, for your house, and so on. So the UK, in mixed all this together, is the most highly insured country per capita in the world. You will see. If other countries approach this level of insurance, and the insurance industry is king. It's the biggest industry, right? But some are approaching and some are not, and we will see why some of the Muslim countries are behind, although their GDP per capita is the same as here, or higher.
state provide something rather than taking insurance they're taking contribution from this public in some of the most affluent Muslim countries.
But that's also an insurance, isn't it?
Well,
If you know the state is going to provide, so you have peace of mind. You have an insurance, right? Or if you have larger family structures, then most of the immediate contingencies are taken into account by your family. So you're not worried that if something happens to me, what happens? You know that the larger family will take care. Only when these things break down, you need to look after yourself, right? So that's a different consideration. Okay, then in order to do that and provide all this stuff for insurance, there is clearly, if there is no regulation, a lot of room for a lot of mis-selling, hanky-panky, all kinds of things, right? So you need a regulated industry which delivers on its promises and which gives you, last thing you want is that you go and claim my house is burnt down and the insurance company say we haven't got enough money. Then you're not going to be a very happy person. So there is, like banking, and you have these deposit protection schemes in banking, you need a bottom line in insurance that no claim will be refused. Genuine claim, of course. There can be disputes about claim. The claim is proved to be genuine, it cannot be refused. Otherwise, there is no point in insurance. You can't go and correct things at that time. When somebody has died or when somebody's property is burnt down, you can't do anything.
mis-selling has happened in the UK.
It has happened and is continuing to happen, but at the bottom there is a regulatory structure which puts a line under it, that's the end of it. Okay. And finally, insurance evolution. You can provide conventional insurance in two ways. The original way, which is very intuitive, is people come together and say, we share this risk. Everybody puts into the pot. Anybody who suffers a misfortune is entitled from that pot. It's called risk pooling and risk sharing, yes? This is still there in the cooperative model here, in the mutual model here. There are no investors, no shareholders, nobody. It's the people who are concerned with the risk, they pull it. Even today, some of the largest risks are done by pooling. So for example, all the shipping insurance is done by what are known as P&I clubs, protection and indemnity clubs. These are pooled. All the ship owners, they put their premium in. If there is a loss, then it is paid from that pool. If there is not enough in that pool, everybody gets a call for excess payment for that year. And they put it and they do it. So you have this pooling method, which has this drawback that if there is not enough, you can get a call for putting more. So it's an open-ended thing, right? The other method, which has been sort of getting momentum over the last 50, 80 years, is that somebody says, look, I am putting the capital. If you pay me X amount, I'll take the risk for covering that. So you transfer the risk to me. It's a risk transfer model. This is the most common conventional model. It's a contract of risk transfer. I'm saying I buy the risk from you for a certain payment from you, full stop. So it's a contract. And that's how most of the conventional insurance companies are run. The mutuals and the cooperatives are a very small part, maybe 20% max. 80% is now conventional insurance. Risk transfer. And we have Sharia challenges with both. So I just want to put that in front of you before we go into what is the situation here. Okay? So we are clear about insurance. General insurance relying on statistics and larger pools. Life-driven insurance relying on life expectancy against statistics and larger pools. And who are the professionals who calculate these statistics and insurance premiums? What are they called? Actuaries. There's a whole profession like accountants and lawyers called actuaries. This is their job. Well, most people think they are most boring, but they are probably the top paid professionals in this sort of field. Sorry, I forgot how to do this.
On the right.
This one?
Yeah. On the right, yeah.
Okay. Then we come to products, right? What kind of products there will be? For general insurance, as we said, you have property, travel, motor car, all kinds of things which you want to insure, which you possess. For life and family, you have pure protection that if somebody dies, the family gets X. But normally it's linked to investments, as we said, either for education or for any other kind of, or pension typically. Pension is also a life contract, right? So what does a pension do to you? What does a pension provider promise you? Anybody?
Quality life after work.
After retirement, right? So now if I am a pension provider, you come to me and you say, look, I want to make a pension, right? So I say, fine, you want to retire at what, 60, 65? So you say 65, right? So what do I have to think about it now?
How long am I going to work?
How long are you going to live? If you're in Philippines, I don't have to worry because you'll be gone. Yeah, on average. But if you're here, I'm looking at 15 to 20 years of pension payment. Yeah? So it's life expectancy based, and that's why I'll say how much you want. Do you want X amount or so and so? So then I can calculate what sort of premium or what sort of contribution I need to charge you to do that, depending on what sort of investment return I'm forecasting. And investment return forecasting is another problem. It's not an insurance problem. It's an asset management problem. And if you look, and those of you who know compound interest or compound returns, the difference between a 4% return on average annually and an 8% return annually is huge. It could be a difference between very small pension and a very decent pension. This is not an insurance problem. It is an investment problem. And that's why in the insurance part, especially in life, most of the investment management and asset management depends on long-term products which deliver good, solid returns. What are these? Michael, long-term, solid returns? Exactly. Sukuks. You don't have sukuks, you don't have this business. Out. So this is show you how it leaks to your investment business. Other parts of your investment. All right. So you have investment linked, you have education, health policies, pensions, annuities, and then you have large risks, which, as I told you, are aviation risks, shipping risks, earthquakes, climate change, and so on. And if you think, some of the biggest reinsurance companies in the world, one of the biggest reinsurance company is a company called Munich Re. Yeah? So there are Hanover Re, Munich Re, Swiss Re, and Berkshire Hathaway. I think these are the four biggest, plus the Lloyd's insurance market. Munich Re, 5 years ago, they invested $4 billion in a project which is designed to bring solar energy from the Sahara to Europe. The project plan is that 15 to 20% of European energy needs will be met from solar from the Sahara, because we are just across the sea and the Sahara is there, 24/7, 365 days sunshine, no interruption, nothing. There are challenges to executing that project, but in principle you can see that it is doable. Now, I'm asking Munich Re, why do you want to invest $4 to $5 billion in this? What is to do with a reinsurance company? They said, we think that in 20 to 30 years' time, the big risks which we have from climate change, etc., can be mitigated if we switch to renewable energy. And therefore, this investment will pay back in terms of fewer claims on our business, which we have written. See where it operates? If you have fewer claims for, say, climate change related claims, which could be floods, which could be sea level changes, which could be crop changes. If you are a reinsurer, you are taking the ultimate risk. If you have fewer claims, you have to pay out less. If you have to pay out less, you make more money. Can you invest some of that into making sure that you have fewer claims? Yes? So, some of the big reinsurance business is big, and you have to think quite differently from what you would see in a normal, ordinary, small size business. And these big companies are big, huge. Okay, so these are some of the products, and in different markets, these are packaged according to the prevailing custom, local tradition, what is acceptable in different markets. So if you go to the States or here or Europe or other countries, you see the same thing being marketed as different names. But underlying, these are the principles. It's trying to design to meet certain needs which people have, of mitigating risk, which is beyond their own control. And this is something which finds resonance in Sharia. We have traditionally, for example, the situation where, for example, if somebody was killed as a result of manslaughter, this is very important. It's not criminal. If I murder somebody, there is a remedy in court. This is manslaughter, which means it happened. Not intentionally, but it's one of those things which happens. And if that person is a breadwinner, how does society compensate that person? So in traditional societies, which was present at the advent of Islam, there is this concept of diya, right? People would pay to compensate that person, because that's essentially. And what happens if there is no direct descendants or direct family to pay? Then who will pay?
The government.
Baitul Mal?
Baitul Mal, yeah.
Well, before that, there is also a provision that the larger tribe will pay. Akila, exactly. And then there is a provision, before going to Baitul Mal, there are rings of people who have stakes in that society to pay, right? So this is essentially what insurance is about. It's not new, and it's not unknown. Different societies have solved this differently. In, for example, Egypt, where lots of merchants were financing voyages at the time when Muslims were trading quite a lot with Southeast Asia and so on. Now, in those days, when you don't have communications and so on, you had, for example, these ships loaded by goods which were bought on the basis of mudaraba, on a risk-sharing contract, that they will take these goods, sell them, and come back and share the profits with the provider of capital, which is very simple, straightforward. Now, what happens if a ship is lost. Everybody loses money. The next contract, the profit share will go up to compensate for that loss. Yeah. If there's no loss for another 4 or 5 voyages, then the share will again come down. So there is a natural risk adjustment to the even Mudaraba share. All right. So you can see that different societies, different parts, different requirements have got how to manage these risks. Risks are there. They cannot be taken away. They need to be managed. And that is what is the essence of insurance and Takaful. It's just how you provide that within a Sharia context. Okay. So conventional insurance, as we said, has now become generally shareholder driven. And okay, it is divided to general and life, reinsurance. Okay, let's just cover this. What is reinsurance?
Insurance company insure their company to be answered.
Insurance for insurance companies.
Yeah, in transfer risk from the participant to
Not from the participant, from the insurance company.
Insurance company.
The participant has nothing to do with the reinsurance. Yes?
Burden transferring to other shoulder.
participant.
Huh?
The burden transferring to other shoulder.
Yes, but the company,
Participant.
the insurance company, not the insurance participant. The participant has only the link with the company, right? Then the companies, they transfer the risk between themselves, right? Yeah, okay. Now, why do the companies have that reinsurance?
Because maybe sometimes the risks they carry are too big for them.
Are too big, yeah?
Financially and otherwise. So
The risks are too big, so
they have to share it with another company. That is
exactly. Now, what is the cost of reinsurance then?
80% of
No, cost. Huh?
The cost.
Say if I'm getting £100 from you to cover your risk, whatever it is, right? So I pocket £100. If you don't claim anything, I make £100, right? If you claim something, I have. Okay. How much I have to pay to the reinsurance company to take the whole or part of that risk?
20%.
Depends.
20.
It must be less than 100, for sure, to make economic sense.
It can't be, it is not necessarily 20. So essentially there is a cost, right? And every cost reduces my profit. Yes? So now I have a tension here in my mind between making higher profit or lower risk. So you see why reinsurance is a subjective question. How much I do it? Do I want to take a higher risk and pray to Allah nothing happened to you? Or I want to see that, make a balance, yeah? Cover that risk and then pray to Allah. So you see, reinsurance mitigates risk by the cost on your profit. So you could be very stupid or you could be extra cautious. In which case, one case you might lose your pants if you lose. In the other case, you make very little profit. The regulator has something to say on it, the actuaries have something to say on it, but at the end there is a boundary which is your judgment, how much of that risk to park where. So that's reinsurance. Let's put it there. And retro for large risk. In terms of licensing for insurance and Takaful, different jurisdictions look at it differently. Some jurisdictions like the UK, they believe in separate licenses. So you have one license for life and one license for general, because they think these two are different kinds of business. In places like Malaysia, they understand that in a different way. They look at a composite license. So they give one license for insurance, life and general, another one if you want for reinsurance, life and general. So they look at horizontal, here we look at vertical. And different jurisdictions have a different take on it. So in any case, if you want to do everything, you will need 2 licenses. Okay? And as you understand now, when in an insurance company, generally, when you insure your motor car, you pay your premium either by installments or day one, right? And you make your claim
If there's any need.
anytime in the year, right? So generally, they are sitting on premiums until claims are made. So sitting on funds. So what do you do with funds? Invest it and make some return on it. Yeah? This is for general, which is more or less settled year after year or finalized every year. Your motor premium finishes, claims finished, end of story. For a life or a pension contract, 25 years, 30 years, 40 years. So the insurance company is sitting on huge amounts of money and they need to invest it wisely, because if they don't invest it properly and somebody else does a better job, you lose your competitive position. So asset management becomes very, very critical for life companies, less critical for general companies, but still an important aspect. And of course, the regulator has a lot to say in what kind of assets you can invest in. You may think, for example, that investing in shares or stock markets is more profitable. But the regulator may think otherwise. Why should that regulator think otherwise?
Protect the interest of the principal.
In what way?
Because if the principal amount is lost in the share market, then there
So,
is nothing.
share markets, you know, typically are volatile, right? Claims do not wait for the market to go up. So when the claim happens and you want to sell shares at the bottom of the market, you are in trouble. So you want to balance that. So the regulator is looking at liquidity first and return afterwards. And you have to mix and match that, and we will see some of these insurance problems. It's not free for you to invest as you like. The regulator has certain levels and limits which they will put on you for that, okay? All right, the other way, as we said, is mutual or cooperative, where you share the risk. There are no shareholders, and it is a pooling of risk. The participants are the owners of the business. And essentially, in Takaful also, you will see that the participants are what we call the Rabbul Mal, the owner of the assets. And they then give it to management to manage the risks or the investments or whatever it may be. Now, if you are the owner, you have ownership rights. So what happens? And in an insurance setup, you have a very, very typical problem. Well, 2 problems. What happens if, for example, claims are more than the contributions? Yes?
You ask participants to reimburse.
No, I will take out Hassan's own shareholder.
There's no shareholder here.
To borrow.
In a proper structure, there is no shareholder. I'm not looking at the couple yet, yeah?
But if the claims are more,
You ask for participants to give more, yeah?
you either raise your premium or you and borrow
Borrow from where?
from a conventional bank.
Who is going to lend you on this?
Bankruptcy.
So, park that problem one side, okay? What happens if the claims are less than the contributions? You have a surplus, then? What do you do with the surplus?
Invest it. You can invest some of it.
Yeah? Give it back to the owners? Yes? Give it back?
Depends your strategy.
Keep it for next year and reduce
Keep it for a rainy day? Okay, so if you are now a participant and an owner by default, And you see that there is a reasonable surplus here. And the management is suggesting, as Don says, keep it. Because next year
It's raining.
it's raining, then you don't need to borrow or you need to ask the participants for more. So you reserve it. So that would normally be the case if you are an enlightened participant. And if a mutual or cooperative business does well in the first few years and reserves enough, it can become a viable business. The risk is in the first few years when there are no reserves. Big risk. And this is why some of the bigger cooperatives are surviving, because they have good risk pools, right? But this also works if you are going to stay with the company. If you have been there in a good year, your intention is to take my part of the surplus and go to somebody else. Next year may be bad. And this is an insurance problem across insurance industry, that the people who incurred the loss or participated in the surplus are not necessarily going to be the participants next year. Not so much in life, but quite clearly in general insurance. In life, it's not so easy to cut your losses and go in the middle of a 25-year contract. In general, it is year to year, right? So there are challenges on these, but in general, if you manage to build reasonable reserves, you're fine. You can work a cooperative model quite successfully. Normally, it takes 50 to 100 years for cooperatives to become solid. Those who survive the first 5 years or so on, right? They become quite substantial, solid, huge organizations. The challenge for Takaful is that we came on the scene, we like the cooperative model, we don't have 50 years to stabilize. So what do? We want an injection of funds, day one, and we want a lender of last resort, but we want to keep the cooperative principles. This is the challenge. Yes? And so we will move on to see how we solve that challenge now. So, the Sharia objections to insurance overall. Although you will see these three quite common: gharar, which is uncertainty, maisir, speculation or gambling, and riba, interest, usury, whatever. Actually, these are not objections in the real sense. These are objections to an insurance contract. Insurance itself is an activity which is uncertain. You might get a claim paid, you might not. You don't know how much and where. So it is an uncertain activity. So the activity itself is subject to these. And the riba comes from two sides. One is obviously if you invest the premiums or contributions in riba-bearing instruments like bonds instead of sukuks, then you have that problem. Or in terms of insurance payments, you're paying more than you gave, so that is an element of riba, question of getting something for nothing, right? So it is inherent to the insurance contract. It is not that insurance is haram. The insurance contract is problematic, because an act in Sharia or a contract in Sharia cannot have these elements, full stop. So, I mean, this is one thing which is very difficult for new students of insurance Takaful to get into them. They come back and they write, it's haram because of gharar. I say, where is gharar? I say, what are you talking about? It's the insurance contract which is a problem. So the only way to out of it
Change the contract.
is not to have a contract. Right? To have a wad. And the payment of tabarru into a pool is a wad, is a promise.
Unilateral promise.
unilateral promise contribution to the pool. Yes?
That's right.
And so that will solve it. But when you do that, you are essentially adopting the cooperative model, risk pooling. Yeah? You're putting into the pool, and you say, if you happen to be one of those persons which suffers an unfortunate incident, you are entitled to take from the pool.
So, are you not saying that the insurance company does not need, for example, you have a car insurance policy with a Re-Takaful, and expiration you forgot to renew. The insurance company does not have the right to write you, informing you that the policy with them has expired.
No, it has. It has.
When you say unilateral, like,
It is unilateral. Say you don't make a contribution next year, then you will not have that right.
but what do they write you?
Yeah?
They write you.
They write you.
Yes, I said please forward to us a check.
Yeah.
For the-
Make your pool contribution for next year.
Okay, so it's still not.
Yes,
contract.
yes, yes. Still not a contract. Yes. So it is a technicality, but you cannot frame it as a contract. In fact, if you look at friendly society legislation here, it says exactly the same. It says that this is a contribution which is not contractually enforceable, full stop. Even now.
So if you have if a guy is involved in an accident and he has a Re-Takaful policy, and you go back to the insurance company, the Re-Takaful company, and say, sorry, my car was involved in an accident. Under what condition will it make good the promise to put back your car in the issue? Do you need to go to police?
So that's why the members' rights are there, to make sure that members who make a contribution are compensated.
No. I'm talking about, do I need to go to a police officer to get a police report?
Of course. No. Those are, because there is, in insurance, there is one big problem in insurance, whether it is Re-Takaful or anything else. And we call this moral hazard. Right? Moral hazard, what do you understand by moral hazard?
Somebody is not being dishonest in making a claim.
Okay.
So
You can get away with it, you get away with it, yeah? You say my car was stolen. Well, it's lying in your garage, right?
But if you come to the garage and see the car dented,
Exactly.
do you still need a police report?
Yes. Because, you see, there is a objective verification needed here, right? To remove Garar as well. And to remove moral hazard. And one of the good points about a mutual contract is that members feel part of that, and therefore the level of moral hazard is less. How else the insurance company reduce that? Say in a motor policy. What are the conditions in a motor policy to reduce silly or small claims? Exactly. Excess, say, okay, first 500, you cover. So if it's under 500, you say, if I make a claim, anyway, I have to pay.
the assessor will come and examine the loss.
So what else?
No claims.
Okay.
Exactly, no claims bonus. You can see these are methods by which you reduce the moral hazard in that particular thing. In life contracts, fortunately, you will not kill yourself to get the money. Some of people do, but generally, that's not something you will do. So you have to find other ways to reduce hazard, yeah?
They found in the second life as well. When they swim back to France or something.
Okay? So remember that these objections really, apart from riba, relate to the contract, technicality of contract law in Sharia, which cannot be used in an insurance contract, because the nature of insurance is full of gara. So this one you can look at later on. This is from Ernst & Young. It just summarizes some of these differences. Now, here is the problem. This is a conceptual Re-Takaful provision model. In the understanding of Sharia scholars, the direction of causation is from the left, contributors or people who pay in the money, and they become the Rabbul Mal, yes, owners of capital. They have put into a pool via tabarru or whatever, yes, donations, gifts, pool contributions, and then they contract the management out to a Takaful operator. That contract of management between the pool and the operator normally is at the moment in three forms. It could either be a Mudaraba contract, which is sharing of the risks, and we will see that, or it could be a Wakala contract, which is an agency contract, the Wakala fee, or it could be a Waqf contract, which is less common but still done. So the contract part comes from the pool to the operator, not from the contributor to the pool. If it was from the contributor to the pool, any kind of act is out. You need an arrangement which is not contractual in the Sharia sense. Otherwise you will be landed with gharar and so on, right? This would be the ideal situation. In practice, because as I said, you want to short circuit the whole long process of building up mutuals or mutual like structures, we brought in a Takaful operator who starts the process. Takaful operator says, I have put capital, I have got the license, now I want you to contribute to buy whatever protection you want. So the Sharia causation and the actual practice is from two different directions. Now, if the Takaful operator is initiating everything, who will own this business? Is the Rabbul Mal or the operator?
Should be the operator.
Then you have a problem, yes?
This is Mudarib Sharik bil Mal.
Yes.
Takaful operator is Mudarib Sharik bil Mal.
Yes.
We will take Mudaraba proportion plus his Mudaraba plus.
It's two types.
Capital and Mudaraba.
But it's not a pure model, right? It is a compromise.
It is a pure model. That Takaful, I am working with that Takaful. If you are working on
Okay, hold your fire, let's go on forward. So anyway, this is a conceptual model which you keep in your mind because that's an important model, right? How it should work and what are the different elements in it. So this is the Mudaraba model, pure Mudaraba model. You have here, the starting point in all these models is participants who are in the conceptual model as well, who bring in their contributions and it becomes a contribution pool, right? Whilst the money is there, it is invested and there is a return on that investment. In the pure Mudaraba model, the operator will only get a proportion of the investment return, nothing else. And so that contribution pool plus any profits left will go to pay claims and any surplus goes back to participants. Is the pure investment return enough for the operator?
what is the question again?
Is it enough? Only the return on investments or a share of the return on investments?
Is it as
Huh?
for the operation or as is
Everything. Except it is only enough if it is a huge contribution pool. say a multi-billion-dollar life pool.
Due to this reason, we are losing. We are showing losses.
Okay. On top, because to make it work now, as I said, what happens if the claims are more than the contribution pool?
We are taking Hassan from shareholders.
You're not taking, he is obliged to put Qardul Hasan.
Yeah.
Okay? Now, how can the claims pool exceed contributions? What are the reasons?
Excessive risk.
Underpricing. Yes? Well, one reason is underpricing. If it is underpricing, it will not be corrected until the pricing is corrected. So, why do you want to give Qardul Hasan to something like that? Yeah? He's not my uncle, yeah? Saying, okay, fine, thank you very much. Okay, what could be the second reason why a claims fund can exceed?
Too many claims.
Actual claims, sometimes the statistical probability of claims is higher. It just happens.
Disaster.
That is fine, because that will be corrected in future years. Right? Hopefully it will not happen every year. So that's fine. What about the third thing? What is the third reason? Any third reason?
Or risk underwriting.
Risk underwriting, that's mispricing, but also there is technical. Poor risk underwriting, high management costs, silly expenses, whatever, right? Those will not be corrected until the management is corrected. Yeah. Now there, the Qardul Hasan makes sense because it's the management's fault. You pay from your pocket, so you will automatically have an incentive to correct yourself, right? It's the underpricing which presents the biggest challenge. To get market share,
The price cut, that's basically.
you tend to underprice, and underpricing risk is disaster.
What do you mean by underpricing?
See, everybody is saying to insure your house, I'll charge you 300. I'm coming here and say 250 to get your business from this company, yeah? And that's the problem. So generally this was the conceptual model for Malaysia, but very soon they found that for a new operation and newer operations, this will not work. The operator is exposed to very high risks and not sufficient returns. So they went to a modified Mudarba model where they gave the operator a share in the underwriting results as well. There you can see that from the surplus is getting.
If less than 50, then it will go.
And so this then raised Sharia objections. Because saying, has the operator any share in the surplus? In order to overcome those issues, people in the Gulf started another model which is called the Wakala model. There you can see that the same participants make the tawarru, but as soon as you make it, the operator gets a management fee, whatever percentage you agree. And so the operator is covered for their operating costs. After that, the model runs the same and the participants get back. Now here, the incentive for the operator is just to get business and to make it work just right, not anything extraordinary.
At last.
So then we went to a modified wakala where we also gave them a performance fee from the surplus. Now, you know, this is not very different from the Malaysian model. So the objections to the Malaysian model are, in my view, quite not substantial. Yes? No, it's fine. No problem. Yeah? We can see it. I mean, there is nothing to object. As soon as you give a performance fee from the surplus, that's surplus sharing with the operator. Yes? You can hold it this way or this way. It's the same. But it is commercially driven, that to give the operator some incentive on the underwriting result, saying if you do better, you will still get another bonus on top. Yes. Now, whether Sharia wants to be commercial or not, that's his decision, not mine.
That's the bonus.
Yes. But here again, there is still one more modification which people have made, which is to see, can we bring some element of mudaraba in the investment management? Because then you say, okay, investments, we share. If you bring better return, we share the return in proportion which we agree. The mudaraba, the other part will stay as wakala.
Yeah, I just one question. In the sharing of the surplus, have you seen that if there's any surplus is shared or if it's a percentage of surplus, you know?
No, percentage of surplus.
Okay. So if there's a certain,
It's a mudaraba, so it's saying if there is a surplus, we share and so, right?
yeah, regardless of how much surplus?
Yeah.
Okay, that's what I'm saying.
This incentive for the Takaful operator will be from profit.
Yeah, for surplus as well, same thing, yeah. But,
If there is losses, then
yeah, exactly. All the models say if there is loss, the operator will put Qarzul Hasan. Full stop. There is no running away from that at the moment in existing Takaful operations.
And the reserves are too small.
And likely to be small for some time. And the problem now is that because of quite a significant level of underpricing in the industry, this Qarzul Hasan has become sticky. And shareholders are saying, I mean, Qarzul Hasan, yes, but how long and how much? And so this is one of the big challenges which is faced by the industry. Okay? Okay, we want to move on. Now, just move on to asset allocation. This side on the left gives you an ideal allocation for an insurance company, general, which meets regulatory requirements and which meets asset allocation requirements. Okay? You can see that the bulk of insurance funds are parked into what I'll call debt securities because of their long-term nature, stable returns. And until recently, safe, but now I don't know if even sovereign debt is safe or not. But that's something for Michael to untangle, not me. All right, so, but on the right, you have the allocation of the Takaful companies. Typical. And what do you see there? Why should that be so?
More difficult for debt securities.
No debt securities. Not enough debt securities, right? So in order to have liquid or near liquid resources, you put your funds into cash. But as soon as you put them into cash, there's no return. So you go to the other two bits, equity and alternative, and you increase your allocation there. Now that means higher risk. So here you have, for the same return, the Takaful companies either take higher risk or accept a lower return. And that's one of the challenges in places like Malaysia, that if you want to be competitive in an industry, you cannot afford that. And so developments in asset management, things which Salman Bhai has been teaching you, with all the bells and whistles of derivatives and so, these are all designed to improve asset returns on an average portfolio. If you can't do that, we have problems in insurance. Okay? And here you have, for example, if you look at technical returns, on the right side you have the Malaysian companies. On the left side you have a GCC sample. The yellow bars show you investment income as a proportion of total insurance company income or Takaful company income. And you can see that in the Gulf at one point, investment income formed about 97%. Why would that be so? 2006? Huh? Before the crisis, yeah. What asset class? Property, exactly. Or even equities in Gulf countries were property companies. So essentially it was a property play. When property prices collapsed, look at 2000. So the stability of the industry is in danger. Look at the Malaysian model. You have a steady 20 to 30% from investments. The others, 70-75% of the return is from underwriting results, technical management of the companies, not from investments only. So you can see how much difference it makes. And why can Malaysia do that? Essentially, in my view, because Malaysia has an active Islamic bond market. You can't do that without a bond market. And I leave it to you to discuss in your rest of your workshop here what are the key contributing factors to have an active Islamic debt market. Can you have it? Do you need derivatives for that? Whatever else you need. Okay. Investment composition, again you can see the same thing in a different way. The yellow band shows equity investments, which are more risky. Left side GCC, you can see the same thing again. The next band is real estate, and then the third band is sukuks. Now you can see again that in the Malaysian context, the sukuk component is steady at 25 to 30% because there is availability of sukuks and debt securities, Islamic debt securities. If it is not available, you can't do it. And therefore, Malaysian companies have been able to do much better. However, given even all that, the gray bars are returns of insurance companies, and the yellow bars are returns of Takaful companies. You can see that Takaful companies are making lower returns than insurance companies. So where are investors going to put their funds? Takaful or insurance companies? One of the reasons why they are making lower returns is lower investment returns, is unavailability of certain asset classes, etc., etc.
I have a question. In that same process, is the lower return also based on sharing the surplus with the
There is no sharing yet. It's still full of Qarz al-Hasan.
I thought you said that you share the surplus.
If there is a surplus.
There's no surplus?
Or before you share, you have to pay the previous Qarz al-Hasan, right? Of course.
There is no profit, no surplus.
You don't become bankers, yeah? You take your bonuses and then leave the taxpayer to fund the loss.
We are losing
This
money.
cannot happen. At the moment, the surplus sharing doesn't yet eat into the returns. That's what it is, right? At the moment.
In the Malaysian model as well.
The whole market. I think it's the first year Shirkat Takaful has shared a certain amount of surplus, yes?
In Malaysian context, all the Takaful operators are sharing secrets because not so much of Qadr Hassan.
Not now, yes.
Because since 2005 onwards, most of the Takaful operators they have shifted from Darabang model to Wakalah model.
So not that much loss, yeah. So part of that process is coming to maturity now, and they are beginning. But even that will not impact on the return on equity. It will be fine. The return on equity is impacted by the other factors in the industry. Okay.
Because I was going to ask that because my second question was going to be that, yes, it may be low return, but is it accurate to say that the shareholder or the policyholder are more benefited from the profit than the insurance?
Yes, but the shareholders will equally benefit. So I don't think it will impact.
the shareholders.
Yes, yeah. All right. Now, let's go to this. This chart is quite interesting. This is insurance penetration. What you see the yellow dots there are the member countries of OIC, Organization of Islamic Conference, or Muslim countries, right? And you see the trend line of what insurance should be. So the world is there, and then of course USA, Canada, Germany, France are much above the trend line. And the UK, we are outside the graph. I don't think many of you see it. As I told you, we are here, right? We are the most insured country. We can't, I mean, just out of the trend line on the other side, not on this side.
Where is Japan?
Japan will be somewhere on the trend line or just above the trend line, yeah? So that's, Japan is fine. The countries which I want you to look at is, say, UAE, Kuwait, Oman, which are reasonably wealthy countries, but they are much, much below the trend line, which means the take-up of insurance in those countries is much lower. And we got to figure out, why is this so? Do people consider insurance to be not permissible? Or are lifestyles such that they don't need insurance? Or what? Or have we not marketed the product sufficiently to them? You can see that Malaysia is moving towards the trend line. In fact, it is one of the few Muslim countries which is getting closer to the trend line there, yeah? So that's not very far. Okay, it's not an excessively rich country. You have average GDP per capita, I think between $7,000 to $10,000 per head, yeah? Not $30,000, $40,000, which is what we have here. So you have that difference. And that is something I want you to think about when you reflect on Takaful, that why should these countries, which are reasonably wealthy, are far below the trend line? So that is what is not realizing the potential of Takaful as much as it should, and may not realize as insurance increases.
Can I ask a question here
Yes.
regarding the rich countries? UK has a national insurance contribution set up. It states in the Middle Eastern or GCC, where the state provides the healthcare or other educational or other corporate companies come in as operators and offer them a national insurance which is only funded by the state rather than in the UK where it is two contributors, the employer and the employee.
It's coming. This is going to be what is going to happen in the next 10 years. And then the state slowly will fund less and less.
And
Yeah?
that's the
Exactly.
contributors.
Yeah, that's coming.
I heard it's in Saudi Arabia and things like that.
Everybody is thinking, because it's not a bottomless pot, even state, but yeah. All right, now, just to make sure that, well, these are some of the newer Takaful markets, which you can see there is potential, it changes in many of those places. What I want to do now is to really move, because time is of essence, is looking at creating the Takaful brand. And this is from one of my close friends, Ajmal Bhatti. This is a very, very interesting presentation. I borrowed some parts of it, which is permission, obviously. What is the definition of Takaful? Look at the web definition of Takaful. If I came to you and said, this is what I'm selling, would you buy it? And then I came to you with this definition of insurance. Look at the definition of insurance. There is no 1400-year history, there is no this, that, there. There is a very clear thing that if you have a loss, we pay you full stop. Makes sense to you, yes? So clearly we haven't got what Takaful is about yet. And then, but it can be defined. And Ajmal Bhai has attempted, for example, here, look at that. Now that will stand against the definition of insurance. It may appeal to you. So there is a challenge there. and then you look at all the other bits of how it works, right? And you can go through those slides later on and see what will happen. But let's move on to the next one, next challenge, which is what we call the new media, right? When you start marketing the Takaful, you say, okay, we want to use social media, new media, and so on. What is the distinguishing characteristic of new media? And it is this. Web 1, you are preaching. You are saying, I have a website. All the information is there. Go and look at it. You are making your own pitch. Yeah. Web 2, which is what is social media, is interactive. You want the customer to say what you want, and you are responding. So you can see there, you have a different logic and dynamic, right? And these are the Web 2 kind of names which you have become familiar with. What is the key feature of Web 2? If you have a friend, you have a colleague, you have family, you are likely to interact with people whom you trust. That's the distinguishing feature of Web 2. So if you have a brand, you need to create trust. If you don't have trust, you have no take-up. You're dead in the new social media space. And to create trust, you need a clear brand image, clear vision, clear product image, clear idea on surplus sharing, distribution, this, that, what is your unique selling point, what is your model, etc. And then, of course, you have transparency requirements. But in financial services, you also have risk. Because Web 2 also allows bad news to travel faster than good news. One mistake or one strategy not to handle it properly, and your product is finished. So I put a rumor that XYZ company is not Sharia compliant.
Yeah,
No?
happens these days.
It can happen. If you have no strategy to defend it, you better call it a day. Yeah? If you say your product is either not as good or just as good, people say it is not compliant. Why? So, before we go to these fancy ideas that I'm going to do social media and this and that, we need to be quite careful as to what it is about and where we need to go. Right? Okay, last 5 minutes. Re-Takaful. As we said, Re-Takaful is an arrangement where you spread your risk. I think, but it is a cost. So there is a challenge of how much return you will sacrifice for risk mitigation. And Re-Takaful technically can be done in a number of ways. You can have arrangements whereby you can ask your Re-Takaful or reinsurance operator to say, you take X% of all my risk. So whatever I insure, say 30%, 40%, 50% to you for X amount for X share of my premium, right? The operator, Re-Takaful operator, has no choice in saying, I don't like this one and this one. He cannot pick and choose, takes across the board. This is called proportional, yeah? Or you can say, no, I don't want to do that. I want to give you only those risks which I think are more problematic for me. So case by case. There, the Re-Takaful operator has a choice of saying yes, no, and quoting a price on the case, which may work for you, which may not, but it's not a certain arrangement, right? You can't then take on risks and say, I'll pass on because this, I don't like this. Or you have other arrangements like excess of loss, where you say that if the loss on any particular arrangement is more than, say, $1 million, you take the balance, which is cheaper Re-Takaful, because the Re-Takaful operator has got what we call an excess provision. And so you have a variety of mixtures of these kind of arrangements. And one of the tricks of management of a proper Takaful company is to make sure that you have your most efficient Re-Takaful arrangement. Re-Takaful operators also provide you with very valuable services like statistics, support, backup, industry knowledge, and obviously all kinds of other things. So these are also valuable things. But it's a very specialized area of work. And if you see the value of Re-Takaful, which is here, this is the reinsurance ratio. How much you reinsure or make Re-Takaful, right? And one extreme, I could take business and reinsure 100%. So I just become a marketing agent. In days when reinsurance was allowed and Re-Takaful was not there, many companies were actually doing Takaful and then passing on 95% of the risk to reinsurance companies. So essentially they were not doing anything. But if you are careful and if you have a mature industry, you reinsure less. When you reinsure less, you make more profit. So you can see the difference here. You're looking at 50% reinsurance ratios in the Gulf and about 20 maximum in Malaysia. Again, showing the maturity of the industries, of risk management within those operators. Okay, last couple of minutes, emerging issues and challenges. The first one is return on equity. Return on equity on insurance is much higher than on the Takaful. And this is a challenge. And we need to really diagnose the reasons for this and address them if the Takaful is to take its proper share and place in the provision of insurance services in Muslim countries. The second challenge is here. IOF's decision on performance fees. You know that we said that, I told you that surplus sharing performance fees on there are considered to be dodgy, right? Because they are. IOF has come in and come up with a very strange decision in my view, saying that only the management can take performance fees, not the operator. The actual managers. People who actually manage, yeah? The people, not the operators.
So the fund managers.
No, the couple operators managers, not the operator itself. It's like bonuses to bankers, yeah, not the banking company, right? Employees, right. And that really doesn't make sense to me. And there is a huge controversy on that part here, which I have summarized here.
Is there any contract directly with those managers?
Yes, but not on risk share, on surplus sharing. Up to now, the management is paid on whatever, like say sales performance, underwriting performance, and so on, but not on the surplus sharing.
Management is retained by the operator.
Yeah.
But not by the participant.
No.
Therefore,
So essentially, the shareholders are not sharing in the surplus, according to IOF, is a manager.
that's what I'm trying to understand.
Yeah.
On what basis? Because there's no predicate contract.
This is one of those things where IOF has come up with, I don't know from where. And we took it up with them last year at our summit and this year again. And I think Harold was here yesterday, is it? No, Harold hasn't come here.
On Monday.
On Monday, okay, you take it up there with him and say what's going on. Okay, the second one is the Saudi cooperative model. Saudi Arabia has said we don't want Takaful, full stop, go home. We want one model, which is our cooperative model, which has a couple of elements which are problematic. As you can see, of the net surplus, allocate 10% to the participants and 90% to the operator. Full stop. Mandated. Then.
That's the most they can get.
90%.
No, not the operator, I'm talking about the policy.
Yeah, 10%. Yeah. So clearly, this is at variance with the basic principles of Takaful. Now, whether you can call it Takaful or not, if you don't call it Takaful, half your Takaful pool of 12 billion goes. And it is not easy to call a Saudi legislation not Islamic.
But the operators is who are who are the operators? Is it cooperative? Is
Yeah, the Saudi
Companies,
companies.
I
Saudi
mean,
companies. Yeah. Not members. No. They are actually shareholder-driven operators.
then it's not cooperative.
No. It's not a cooperative at all. The name is cooperative.
I see. Anomaly.
Yes.
And the shareholder driven,
Yes.
shareholders are the royal family.
And now they, not necessarily, but they are entitled to 90% of the surplus.
So what are the Sharia objections to that model, besides it's not takaful?
90% of
It could be
surplus.
Sharia compliant without being takaful.
90% of surplus allocation by law
To
to the shareholders.
But if the participant agreed on this ratio, then what is the problem?
What choice have the participant got? There is no other modality in operation in the country.
Is this is the 90% related to underwriting or
Surplus.
total surplus?
No, what
What is the incentive?
Sorry? What is the incentive?
Is the incentive?
They are not looking for any incentive.
No, it's the incentive for takaful operators
To maximize
the
surplus,
claim,
huh?
to maximize surplus, so it goes against the spirit of takaful.
Wouldn't have been the difference if they said they could take up to 90%?
Even then there is a problem.
Even that up to, they said up to.
90% is means everything, right?
That is not a ball, right?
Yeah. All right. Anyway, I park it with you. It's not my judgment. Finally, this is a very complicated and technical issue, and that is to do with accounting and reporting for the government. As you know, there are, at the moment, as far as Islamic financial institutions are concerned, two major concerns here. One is IFRS, and the other one is IOFI. And in many things, these two are in conflict. And one of the places where they are in conflict is in takaful or insurance. Essentially, IFRS does not recognize the separation of shareholder and contributor interests. You have to find imaginative ways to do that. And Solvency II complicates that because Solvency II calculations are going to be based more or less on IFRS criteria. Plus, many countries are making IFRS mandatory for their institutions. So Malaysia, for example, Indonesia, Pakistan, and so on are moving towards an all IFRS regime. So there is a need to reconcile IOFI and other Sharia standards to IFRS ways of reporting. And that's a new challenge coming on, and there are a couple of specific issues which are highlighted here. But just to keep it in your mind that this is something which is going to be the next set of challenges. Fine. To give you some homework, because this is not sufficient time, we have here the address of the International Takaful Summit Archive, which we have been running for the last 6 years. The last 4 summits, all the presentations made are in that. You can go, you can register, it's free, and get all the presentations
Free.
and become free, and become a Takaful expert, right? And the Ernst & Young last 4 or 5 reports are on their site, which I have given here, which are the annual World Takaful reports, which also give quite good data and information on all these matters. And finally, if you are even more enthusiastic, you can come and attend our summit in Cairo in February, 18th and 19th February, inshallah.
Free of cost?
No, free. As long as you can bring yourself there and make your own accommodation arrangements, you can attend free of charge.
This is the cost.
Now, you see, the point is this. There was this person who went to his church or synagogue or mosque and said to Allah, look, if I win the lottery once, I don't ask you for anything more. 5 years the man is going and asking and nothing is happening. And then one day he goes and says, look, if I don't win the lottery now, I am not going to believe in you anymore. And then voice comes, he says, you have not even bothered to buy the lottery ticket. How can you make you win the lottery? So some investment needs from your side, yes?
have to buy the tickets.
Okay, I think we have run out of time. Thank you very much and Assalamu alaikum.